Hello everyone, this is lecture 2 in the residual earnings lecture. So in the residual earnings series, what have we learned from lecture 1? We learned that the residual earnings consist of the earnings minus your CSE, your common shareholders equity, multiplied by the required rate of return. Now, if you haven't had the chance to go through lecture 1, please go through that video because it will make a lot of sense for this video. So I'm going to take an example here, and the only difference between this video and the previous video, so between lecture 1 and lecture 2 if you want, is with lecture 1 we assume that the business was only for a period of 1 year, and we know that this was just an illustration, and in practice this does not happen. And the reason you're valuing a business, or the reason that you're buying a business, is for the foreseeable future. So what we'll do here is we'll take a simple example again. So assume book value per share £30, earnings £5.40, and required rate of return is 12%. Now, equity equity value, you can work with the total number of shares, or you can work with one share, and then to have the final value you can multiply by the number of shares. So it doesn't change the technique. So here we'll be working with on a per share basis. So first things first, what is the residual earnings? So we know from lecture 1 that your residual earnings is whatever earnings you earn from the business. So in this case, £5.40 minus, well, CSE here, since we're dealing with one share, that amounts to 30, multiplied by 0.12 to 12%. And that gives us a residual earnings of 1.8. Now, what's the deal here? The deal is this. Of course, we won't be operating the business just for 1 year. We'll be continuing the business in the foreseeable future. And the assumption is that residual earnings will grow by 8% per annum until perpetuity. Now, if you want to discount the residual earnings, we've learned from class that this is just a present value of a perpetuity with growth, and I'll put down the formula here. It's your cash flow. So in our case, our cash flow or our earnings will be 1.8 divided by R minus G, R being the required rate of return and G 8%. So if we were to discount, so what is the present value of our residual earnings? So the present value of residual earnings, so equal cash flow 1.8 divided by 0.12. That's our required rate of return, and then minus 0.08, that's our growth rate, and that gives us a present value of 45. Now, to value the business, the book value is 30 plus the present value of residual earnings. So in total, the value of the business, at least for one share, is £75. So £75 per share. Of course, to have the whole value, you just multiply by the number of shares. So again, this was a simple example to illustrate how residual earnings work for a business that will continue in the foreseeable future. And in the next video, we will try to take on a bigger example with different figures. So see you in the next video.